Today I'm going to begin with a chart showing the similarities from a chart perspective between today, 2023, and 1987 before the crash on October 19th. I'm also going to cover interest rates, what's going on with the Fed, and home prices, and the status of the UAW union strike against the automakers. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is October 3rd, 2023. The cover slide is a picture of the stock exchange in 1987 during the crash on October 19th. There were 3 days actually that led up to that, and 2 days, and then that day. And the market went down 25%. And the pattern, the reason it caught my eye was that the pattern of today's, the S&P 500 today is very similar to 1987. And this video is I just play a few minutes of it. It unpacks that so you can see really what was going on and actually people's emotions as it was going on during that period, and how those charts look so similar to today. Now, that said, I do want to point out, and he points out as well, that there are differences today than then, and I'm not thinking the market's going to do this. It could do something similar, but I think it probably won't. But it's good to look at because it shows how sometimes the collapses can come out of nowhere. Right now, there's a lot of uncertainty. I think the market's very fragile. It is not a growth environment. And could something like that happen? It would probably take a trigger. Something would have to break, and that we don't see today. And if it does, comes out of nowhere, then the market could decline quickly. But anyway, I'll share this with you because I think it's something you probably have not seen, and it is relevant because it matches that period versus this period. So take a listen.
Hello, everyone, and welcome back to Gold Predict. I posted this chart to members today, and I thought it was important enough to share with you too. So on the left side here, we have the 1987 stock market crash. That was Black Monday, October 19th. And over here, on the right side, we have the S&P 500 in 2023. Some believe that the patterns are similar and that we could see another breakdown in the not-too-distant future. And I also wanted to walk you through step by step what this crash might have felt like, and we'll go through the charts on that, and maybe we can learn something together. All right, everyone, we have the S&P 500 pulled up in 1987, and we're going to walk through this day by day to try to imagine how people felt. So prices were up roughly 39% in the first half of the year. They peaked here in August, and they came down to support, and it looks like we're getting ready for another breakout and higher highs. We have a clear uptrend, higher highs and higher lows, and we have good support at the 308 level. Today is October 1st, 1987. We're going to move this forward a few days. Prices go up a little higher, they reverse, and then they come back down to test this support level around 308. It looks like we're going to hold. We'll find out the next day. We get a reversal candle. All right, looks like we're heading back up. The next day, however, prices reversed hard and closed below this level. And the next 3 days are going to be terrifying. We get a 2.3% down day. Prices close below the 300 level. The next day, the decline is double at 5.16%. And now we're coming into final support around 275. And this was October 19th. Prices closed 20% lower, slashing through the 275 level and breaking the start of the year open. So anybody that had bought along here is now losing money. I am sure people came home and listened to broadcast news, fearful that there would be another 20% decline. The next day, prices did come down a little bit lower, but they reversed. And over the next, I'll just blow through this, over the next month or two, we got a little bit of a triangle pattern. Prices came down to retest the lows here, but I can tell you that after prices broke this triangle here, you see this triangle, this is a nice consolidation pattern. Right here, I would be thinking, okay, we're going to new lows as a technician. That's what I'd be thinking. Prices close below there, and it looks like we have a breakdown, but then they reversed. And this ends up being kind of a double bottom. But just imagine how people would have felt. This was back in 1987. Now the world is far more leveraged. And I do think something like this is possible again. When? I have no idea. But I'd be really surprised if we didn't have another flash crash type event or a 1987 Black Monday. So if we switch back over to the current chart of the S&P 500 in 2023, we see a similar pattern. And what I'll be looking for is prices next week. If they start to accelerate below this support level, and especially if they close below the 200-day moving average, which is 4,190, I would begin to get concerned. I'll be personally watching the crypto market because that kind of acts as a 24-hour VIX. And if that starts to weaken quickly, then that'll be a warning to watch the stock market more closely. Now, I have no idea if prices are going to collapse like they did in 1987. That's a very low probability event. I mean, that's something that only happens once in a lifetime kind of a deal. But the potential is there, and I think we need to be alert and aware of it at least. So I'll be watching very closely next week, and I'll be updating my subscribers as well as YouTube members as well if things start to get a little hairy.
Next, I'm going to play a piece from CNBC with Ron Insana is talking about the interest rate policy of the Fed, what's going on. We're in a period of time where interest rates are just going higher and higher. We're back to a period back to 2008, and I think, and as a result, bonds, I'm going to cover this more, but bonds and bond funds continue to decline. I think last year was almost a collapse. This year it tried to rally a little bit, but didn't, and has continued to collapse. Keeps on going down. Bonds keep on going down, which is hurting traditional investment portfolios put together by traditional investment managers, financial advisors. So take a listen to Ron Insana.
So, Ron, that's a good point, because if you take a look at what's happening right now with regard to the overall pace and the overall kind of macro backdrop, this is very much about an economy that is maybe still on solid-ish footing. It's certainly not growing at a hyper pace. Maybe these strikes and shutdown issues will tap the brakes further on the economy. So what does it all mean about whether or not the markets are going to hold up relatively well, given the fact that this might actually be, in some perverse way, a good thing for interest rate policy in the future?
Yeah, I'm not so sure about that, given what New York Fed Chair John Williams said today, or President John Williams said today, saying higher for longer. It's, my good friend Dan Niles stole my thunder a couple of days ago. I was going to write a piece about having gone Goldilocks 3 months ago and now facing more than three bears. He used that yesterday, I believe, on CNBC.
That's pretty good.
Look, we have more than three bears. We have a shutdown. We have strikes. We have the Fed staying higher for longer. Diane Swank, economist, noted earlier this morning that with net exports being revised upward, we could see third quarter growth near 5%. So that's not going to push the Fed to lower interest rates, even if we have a government shutdown. They're just now so many variables, so many, at least near-term negatives that we're still in the window in which, from a seasonal perspective, stocks are typically quite weak. So I don't see that changing in the next couple of weeks. We're going to need resolution to a lot of these problems before we can make any, clear-eyed statements about where we go from here.
Next, CNBC's Joe Kernan and Becky Quick interview Societe Generale's Subhadra Rajappa. And she does a good job of explaining how the Fed is boxed in. They really have no good choices. And in order to get inflation down, they've got to do something. and 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 she describes it. Every one of them are bad, both in the U.S. and in foreign markets. One of the things I thought was interesting, she points out, is that the U.S. is selling bonds right now into the market. So they're selling about $100 billion worth of bonds, treasury bonds, into the market, sucking $100 billion out of investable money out of the market. What's interesting is, of course, China and Japan, among other countries, are buyers of our treasuries. China and Japan, she points out, are also selling their treasuries into the market. So they are sucking money out of their market, and they're certainly not coming over here to buy our bonds. So they're trying to create, generate liquidity for themselves. So central banks around the world, they've made a series of, in my opinion, bad choices. And it continues to box them into almost no choices. So take a listen to Subhadra Hajapa.
Join us now to talk rates. Subhadra Rajappa, head of U.S. rate strategy at Societe Generale. And I didn't see you nodding, but I read your notes, and I felt some implicit nodding. There are big supply issues and not necessarily receptive buyers on the other side of a lot of debt issuance coming up.
Absolutely. I think the supply-demand dynamics are definitely as skewed as they've ever been in at least the last decade or so. Yes, foreigners have been stepping back. China is not buying nearly as much, and then Japan is also not buying, as much. In fact, they've been selling treasuries. But really, the elephant in the room for me is the Fed. They've been unwinding their balance sheet, and it's QT. They've been unwinding the balance sheet at the rate of $100 billion, per month. And then you have banks and financial institutions also reducing their portfolios after the regional banking crisis. Banks have been reducing their treasury holdings. They have a lot of unrealized losses in their portfolio.
Yeah.
So they really can't grow their portfolio in a meaningful way. So there's a lot of reliance on real money accounts in the U.S., as well as money market funds and hedge funds. So that's really where all the money is going, as opposed to international buyers or the Fed. The way I look at it is the higher interest rates go, the more the chances are something else will break, right? Right now you're seeing, overseas BTP bund spreads are widening. Emerging markets are going to come under pressure as yields rise. Our equity strategists are thinking at 5% as the threshold for, when equities might start coming under pressure. So, the borrowing costs in general are going up. The mortgage market is under a lot of stress.
So the soft landing idea doesn't really work in your scenario.
I think orchestrating a soft landing is going to be quite hard. I mean, the Fed's really not succeeded in doing that, in the past.
Ever. No, maybe, I don't know, maybe. I can't think of, maybe if you go back to Teddy Roosevelt, or was there a Fed? No, it was 1912 or something, wasn't it? Yeah,
I'd say in recent memory, it's mostly been in the 90s where, they raised aggressively in the early 90s. They cut a couple of times in the mid 90s. Again, you had the LTCM crisis where they cut, rates by 75 basis points. And then we continued to expand until, the equity market and the tech bubble in 2000.
So following this, I saw this article on Seeking Alpha. And I'll just read you a comment here, and then I'm going to put my commentary on it. U.S. Treasury returns are on track for the worst month this year as the bond market sell-off continued after the Fed signal that interest rates would remain higher for longer. Billionaire investor Bill Ackman's bet, he's a well-known investor, bet against the 30-year treasuries has paid off, and he expects long-term treasury yields to rise even further amid stubbornly high inflation, which tells me he's probably continuing to short treasuries, and by the billions of dollars. So this is making it very hard for investors to get into treasuries, and for that matter, into the equity markets. This is a chart it's only the 1 year yield on the Treasury. So I know I'm switching from 30-year over to 1 year, but all the charts look similar. The thing about the 1 year that's interesting is that it's a smoother chart. So it makes the same point, just with some smoothness to it. So you see the period of time that where the yield was during 2020 and 2021 was very flat. Now, and then it takes off. Now the yield is inversely correlated to the price. So what that means is that the price, whether it's the 1 year, the 2 year, 5 year, 10 year, 30 year, all of the treasuries are doing the same thing. They're all going up in yield, which means all of their prices are going down. It also is affecting mortgage rates, and it's affecting corporate bonds as well. So corporate bonds and government bonds are all a big part of traditional investment portfolios. People put them in, it may happen with you. I'm sure many of the listeners have portfolios that included bonds. And what people have not seen coming is that yields had to go up. They were at zero. They had to go up. But we, perhaps you, have this mindset that's gone on for a long, long time. For 40 years, yields, generally speaking, have been coming down, and bond prices, generally speaking, have been going up for 40 years. Traditional financial advisors have been trained during that period of time, trained to believe that they will go up, and that bonds, more specifically bonds and bond funds, are a good antidote or a defensive component to an equity portfolio. That time has changed. In late 2021, when yields started going up and bond prices started going down, and they're continuing to go down. Even as I speak, they're going down today. And when that happens, traditional portfolios either become extremely anemic or probably are even into negative territory for this year. So I know that I talk to people, and I know that there are investors out there who literally have negative returns for 2023. Of course, they had them a lot for 2022, but thinking, okay, the market's going to go up. We had some positive signals in the first quarter. Things are looking better. No, not so quick. They've turned around, and now equities are going down as well as bonds. So this is an issue that is at the hands of the Fed. And in the previous videos, you've heard that and not just in the U.S., in other countries as well. So there is in place, it seems that it's going to continue to go down, at least for a while. What I will say, just the counter argument to this, is that bonds are so oversold right now and so negative that it seems to me that there's probably coming a short-term bounce where they will go up a little bit, and I'll call that a head fake, where people will sucker into it thinking, okay, now's the time to get back into bonds. Until we are out of the period of time where interest rates are going up, or the perception that they're going to go up, bonds are not going to go up in value. Right now, they're responding to this phrase by Chairman Powell that the rates are going to remain higher for longer. Now, that was out there last year, but the market gets ahead of itself, and a lot of people were thinking, no, we're going to have a soft landing, and things are that's too negative a talk. I don't want to listen to that. And they started buying bonds. Well, eventually, the interest rates definitely continue to go up. The Fed is not done. Inflation is a long ways from 2%. So will the rate hikes they've done be enough to bring inflation down when given a little bit of time? We don't know that, but I think the market is saying they don't believe that anymore. So anyway, this is an interesting chart, and all you have to do is invert that chart and point it down, and you will see what's going on with bonds. I'm going to shift gears, go over into housing. So this is the chief economist for Zillow, and she's going to talk about the housing market, interest rates. The 30-year mortgage is now at 7.3%, and it does not look like it's coming down anytime soon. At some point it will, but this is putting a stop. I've talked to people in the real estate business. This is putting a stop on real estate sales unless someone is desperately has to buy for some reason. Sales. Talked to one realtor and they said the phone has stopped ringing. So if it happens on the buyer side or the seller side, it pretty much stops everything. Now, I even read this article from one of the hottest markets in Florida, and their sales have now started to slow down. So there probably are some markets or some segments of markets which are still selling, but by and large, most of them have stopped or slowed way down. All of that is a function of interest rates. What I thought was interesting, she'll talk about this, is that if you have, on an average home, if you have a 10% down payment, your mortgage, or 10% down payment, your payment on the mortgage is 40% of your income. If it's a 20% down payment, your payment is 37% of your income. That is pretty much going to stop sales, at least for those who are borrowing via a mortgage. But if a person comes in with cash and the market is, everyone in the food, those who are selling homes and those who are buying homes, if with interest rates high, it's going to stop most of that. So anyway, take a listen to Skylar Olson from Zillow.
All right, for more on surging mortgage rates and the housing market, let's bring in Skylar Olson, chief economist at Zillow. Skylar, great to have you with us.
Yeah, thanks for having me.
What finally gives here? I mean, supply-demand dynamics keep housing prices high. People can't afford to buy. I mean, at some point, something breaks, right? What is that?
Yeah, I mean, I think as mortgage rates have continued to go up, as opposed to trending down as maybe 6 months ago we were talking about, we were at least hoping for, we've continued to see new listings pull back. So you're looking at around, 0.25% down from what was normal in terms of the homes that are dropping into the market. So Diana is totally right there in terms of it's a supply and demand imbalance. So I agree as well. When we're thinking like what has to give, the owner has to have an incentive to sell. If I have that low rate, it's not a financial opportunity from the mortgage market that's going to incent me to move, right? It's a life fundamental. So it's either the time happening of getting divorced and having kids, or it's job loss. And I think that's one of the reasons why right now it's kind of confusedly optimistic, which makes mortgage rates go up because we don't need those safe assets, and they're related, the 10-year. But at that same token, that's going to keep the activity low in housing markets. I mean, the existing housing markets.
Is there a magic number on mortgage rates where you see, deals clearing, an increase in listings, an increase in deals in general?
Yeah, this is the magic question. At Zillow, we're tackling this in a lot of different ways. So every quarter, we're asking existing owners, are you willing to or sell in the next 3 years? Right now, that is highly sensitive to the rate the owner holds. So the higher the rate is, if they have a rate above 5%, for example, they are twice as likely to want to sell within the next 3 years. So not everyone is as deeply locked in. When we think about what is that magic rate, I also think about affordability. So what share would that typical mortgage payment take out of a typical income, nationally speaking? Now that we're up, at 7.3, that share is close to 40% if you only have 10% down, and it's close to 37% if you have 20% down. That's close to not being able to qualify. Once you drip down to, say, 6%, it gets a lot more relief.
Next is Phil LeBeau from CNBC, and he's giving kind of a little monologue commentary on the UAW strike with the big three automakers. And his comment, he's talking about Sean Fain, the president of the UAW, his comments, and he's talking about Jim Farley, the CEO of Ford. And when you listen to both of them, Sean Fain is much more inflammatory, and I don't know, I don't know. It didn't seem like reality. On the other hand, Jim Farley, he's making some statements too about, the unacceptability of the other's proposal. My read on it is I'm thinking the truth is probably somewhere in the middle. But there is now I read the auto workers are now 25,000 of them now are striking. So they've expanded the number of plants that they're striking against. And according to Sean Fain, I mean, they are really dug in. And so this, we're a nation. It's a nation. We have cars and trucks. And so this is, it can't go on for a long time, but yet the demands are very, very high. And the ability to afford those demands, at least as they are right now, is almost impossible. So you think, where are they going to meet? Eventually, money has to come into the picture, and both of them want to make money. So, but it could go on for a while, and to me, it looks like it will. But this is an interesting commentary from Phil LeBeau. Take a listen.
So let's hold the conversation for just a second. I do have breaking news regarding the UAW strike. Yet another thing we need to keep our eyes on. Phil LeBeau has the latest. What do we know, Phil?
Scott, if you want to see how far apart Ford and the UAW are, earlier today, Jim Farley, CEO of Ford, along with other Ford executives, held a briefing with reporters and analysts talking about the fact that another Ford plant, the UAW, is on strike. In that briefing, he said this is a case where he believes the UAW, calling these strikes premeditated. They're holding the representation of future EV battery plants as hostage in these negotiations. I mean, he blasted the UAW. Well, now the UAW is out with a statement from President Sean Fain, and here's what he says. Listen to this carefully. I don't know why Jim Farley is lying about the state of negotiations. It could be because he failed to show up for bargaining this week, as he has for most of the past 10 weeks. If he were there, he'd know we gave Ford a comprehensive proposal on Monday and still haven't heard back. He would also know that we are far apart on core economic proposals like retirement security and post-retirement health care, as well as job security in this EV transition, which Farley himself says is going to cut 40% of our members' jobs. Like a good neighbor, we're available 24/7. Name the time and the place you want to settle a fair contract for our members, and we'll be there. That last point about being a good neighbor is in reference to Jim Farley saying that Sean Fain is on TV more than the State Farm guys on TV. Bottom line is this, Scott, we're nowhere close to a contract being reached between Ford and the UAW. And basically, you can say that with the other automakers as well. Long ways to go before we see this resolved. And as I've said for some time, Scott, do not be surprised if we see more strikes in the weeks to come.
Yeah. Phil, thank you for the update there.
Okay, we're in a bear market, and in my opinion, and at least the beginning of, I believe, a long-term secular bear market, but this is probably the cyclical bear inside of a longer-term secular bear. And for 15 years, since 2009, we have been in a period of a bull market up until through 2021. And during that period of time, there were minor dips. The market would go up and then it would come back down. That would be a dip. And there was this phrase called buy the dip. Well, and then it would go up. It happened over and over and over again for that entire period of time. Well, from 2009 through 2021, what is that? 12 or 13 years. So during that period of time, and people got used to the idea, market's going up, market's going up. Well, not anymore. 2022 showed us that it was, generally speaking, a market of decline. During that period of time, there were periods where it would go up, I call it a head fake, and then it would collapse. Go up, head fake, collapse. And so, and here we are in 2023, and we've had the early part of the year was gains, and now we're experiencing some losses. Market's going back down. I don't know where it's going. I try to stay away from predictions, but I would say that there is still this mentality of buy the dip. Until the bears come in and take full control and push the market down, where people are stripped of their optimism and finally believe that we are in a bear market and we as investors have to behave differently and think differently in a bear market versus a longer term bull market. And I think people are starting to wake up. And in my opinion, we are in a bear market, and we have to just think differently, think defensively, and whatever that means to you. And so anyway, I thought this was a good card to think about the pattern for the last 12, 13 years of buy the dip. Be careful. Thank you for watching. And if you have questions or comments, leave them in the comment section below.